Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a series that aims to focus on the trend lines rather than just the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Hi, this is Kevin Roskam with USA Financial for your May 2025 monthly trending report. This report is going to be interesting because the market has been interesting over the last 60 to 90 days. And some of the things I've said over the last 60 days, I'm going to say again today, but because the market's moving in an opposite direction. This trending report is really a reminder that we watch the trends. We wait to determine, is the trend moving in a certain direction, and then we act on it. Nothing that we do in terms of formulaic trending, whether it's USA Financial formulas or the other money managers that we have access to on USA Financial Exchange, is anticipatory. We're not sticking our finger in the wind, nor are any of the managers we use, and trying to guess where the market is going. What we're doing instead is relying on unemotional, formulaic, disciplined strategies to expose our clients to the market. And over time, we know that that has been successful. And we also know in talking to hundreds and hundreds, if not thousands of clients, that risk management is what they desire, especially as they get closer to or they're in retirement. The ability to avoid market volatility, avoid uncertainty is what clients ask for. Sometimes avoiding the uncertainty and avoiding the volatility means avoiding some of the short-term growth that we see in the market. And that's where we are right now. And so for this market trending report, there's a couple of things I want to go through to remind you, I suppose, of what long-term investing feels like. Maybe you've seen this before, the cycle of investor emotions. I felt like we're at a point in the marketplace where we need to review this diagram. Because a month ago, we were feeling terrible about the market. Today, we might be feeling great about the market. Maybe you're still feeling nervous about the market, and this will reassure you, hopefully either way, that investing for the long term requires controlling your emotions over this stock market roller coaster. So what we see here is really simple. Before someone ever invests in the market, or when they think about investing in the market, when their money isn't exposed, they typically are optimistic. They're optimistic about, hey, I have this extra money, I'd like to get it invested, or I have money sitting in cash, I'd like to get it invested. I know that over time the market is the best place to be. And so there's a feeling of optimism. And on the way up, that optimism turns to excitement and to thrill. Excuse me. And at some point, somewhere near market highs, there's something that investors feel like euphoria. A term that's come up over the last several years that maybe you're unfamiliar with, or certainly you don't use like younger people do, is the idea of FOMO, the fear of missing out. That fear of missing out happens when the market is moving in an upward direction, of course. No one's fearful of losing on the downside. But every down day, certain people have a fear of missing out, that tomorrow the market's going to be up and I should be invested in it. Well, what we start to see is as the market, and we saw this over the last 90 days, we feel anxiety. We feel like we have to hold. Eventually there's fear, there's desperation, there's panic. And for the emotional investor, somewhere near the bottom of the market, there's a depression and a tendency to sell. Once someone has gotten out of the market, they feel that relief and that hope and that idea that, you know what, at least we're not losing money. And then that entire cycle of investor emotions starts again. So one of the things that you need to do as an investor, maybe even as an advisor, is figure out where you are in this cycle. Because no one ever really knows where the market is in this cycle. And as I show you the trends, you'll see some of that, and I'll refer to that again. But one of the things that I looked at and wanted to share with you this month is something very interesting to me. Because as we talk about how the tariffs will affect the world economy and the stock market and all of these things, one of the things that we can look to is this thing called the Baltic Exchange Dry Index. And very simply what this is this tracks the cost of commodities and the cost of shipping commodities over the water on ships between different countries. The Baltic Exchange Dry Index is a really good leading indicator of where people believe the market is going. So this is, what does it cost to ship coal, to ship iron, to ship those types of commodities? And so what you're looking at here is over the last calendar year, what this dry index has looked like. Now, obviously, typically as demand lowers, the price lowers. And that's what we see here. And initially when I looked at this, I thought, well, that makes sense. There's fear in terms of what tariffs will do because of tariffs and because of some of the shock that's been involved. Shipping and pricing has changed and lowered. Now, just like every other trend, I think it's important to back up and take a look at what we're actually seeing here. And so what I did is I looked at this chart over the last 5 years. And one of the interesting things is if you look at these low points, most of these low points, so here's a dip, which is January, February of 2025. Here's January, February of 24. January, February, January, February. And a smaller dip, in January, February of 2021. So some of the dips that we've seen are not just tariffs or threats of tariffs. Some of it is actually seasonal. But certainly we can see in terms of a 5-year number, we are closer to a low than a high when it comes to the price of shipping goods, commodities overseas. I think that's important to know. We're at or near a low, but we're not at the low. Another thing I thought was important to look at was the import and export volumes processed at U.S. ports. Now, this is through actually, I think the middle of March of this year. And what's interesting here is, again, if we go back to 2022, where this starts, we can see that there is a shift. But specifically Los Angeles, Long Beach, which are two of the heaviest, and then of course New York, New Jersey, those are the three main import-export volume ports in the United States. We see that we're not at the lows over the course of the past several years. We can see that our main three ports are certainly down over the last quarter, ever since the threat of tariffs became real. Some of the volume has come down. We can also see that there's other ports where the volume that they're responsible for has either raised or not moved a ton. So the reason I show you this is because depending on which network you're watching, depending on where you get your news from, we're either suffering from tariffs or threats of tariffs, or We're already experiencing the benefits of tariffs or the threats of tariffs. The fact of the matter is, what we still need to do, regardless of what's going on in the economy, is look at the overall trends and have an understanding of what the purpose of our long-term money is. And so the reason I wanted to show you these shipping charts is because even though we can be running the gamut of emotions right now, from last month's trending report to this month's trending report, you'll see that the market is almost a complete V. The one side of the V affects our emotions, but so does the other side. And what these shipping charts should tell you is that there is uncertainty. There are things to be concerned about. But the biggest thing to be concerned about is, has my long-term plan changed? Because if your long-term plan hasn't changed, this uncertainty was built in. It was part of the plan. This is why we use multiple money managers. This is why there should be different things going on at different times. This is why your advisor is probably not as nervous as you are. Because uncertainty is almost one of the certain things when it comes to the stock market, or at least volatility is one of the certain things. So here's our trend for the last 30 days. And if we just, again, focus on the last 30 days, and then we think about that cycle of emotions, we should be optimistic. We should be excited. We should be thinking now's the time to get back into the market. But that's why we have to come out of that and look at the trend versus that V shape of the market. Because just 30 days ago, we didn't feel that euphoria. We didn't feel that optimism. We felt the fear. And so between here and here, what's changed? Because from here, middle of March of 2025 to middle of May of 2025, the market is still down. And so even though the 1 month trend looks very positive, we have to pull back and say, where's the 2 month trend? Where's the 3 month trend? Why is my account that has risk management involved, why is it not doing what the market has done over the last month? Well, most likely because risk management includes avoiding risk. Avoiding risk sometimes means avoiding the market. And so when a money manager tries to manage volatility, they're doing it for the long term. It's important to remember your portfolios aren't typically built to beat the market this month or to beat the market this quarter or even this year. They're built to manage the risk. How much risk do you need to take in order for your financial plan to be successful? I hope you don't need to take all of the risk in the S&P 500. Because that, as you can see on this 1 year chart, that's a wild ride. And so where are you on that roller coaster of emotions right now? Because even as the market has gone up, and maybe your risk managed accounts haven't seen what the market has seen, remember why. Because that's how you experience long-term success. Now, again, part of managing our emotions is looking out over 5 years. What we're starting to see now over this 5 year period is, and the question I would ask, how did you feel during 2022? Because during that time, there was risk management in place and the market was volatile and the market was down. How did you feel in 2023 and in 2024. It's so important when we talk about being exposed to a long-term investment plan that we remember why we set the plan up the way we did, what the plan is meant to accomplish, and where we are in terms of the long term. Because you see, as we sit today, a lot is going on. There's a lot of news. There's a lot of activity, not just politically, but economically. And it's so important to understand that our advisor set up a plan for our long-term money to interact with what's going on in the marketplace and what's going on in the economy, to manage risk, to take risk necessary, but not to take unnecessary risk. And so as the headlines continue to change on a daily basis, as the market continues to move up and down on a daily basis, the message for this May monthly trending report is to remember that trends take time, because trends are measured, they're unemotional, they're formulaic. And the plan was put in place for you to be able to navigate through the volatility and through the uncertainty to long-term success. This is Kevin Roskam with USA Financial with your May monthly trending report. Thanks for listening, and we'll see you next month.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.